You don't need to pick stocks to get rich. This simple 3 ETF portfolio quietly made beginners wealthy. Let me start with something most people won't tell you.
When I first wanted to invest, I thought I had to pick stocks. Apple, Tesla, Amazon. I believe that's how real money is made. So I watched hours of videos, read tweets, followed experts. And honestly, I felt more confused than confident. Every stock looked risky. Every opinion contradicted the last one. And the biggest fear was this: what if I pick the wrong stock and lose years of savings? If you are watching this right now, there is a good chance you feel the same. You want to grow money. You want long-term wealth, but you don't want stress. You don't want to gamble, and you definitely don't want to stare at charts every day. Here's the truth I learned the hard way. Most beginners don't lose money because markets are bad. They lose money because they make investing too complicated. Stock picking sounds exciting, but for beginners, it's often the fastest way to panic, overthink, and quit. That's when I discovered something surprising. Some of the calmest, most boring investors were quietly building serious wealth. No stock picking, no predictions, no stress. Just a simple 3 ETF portfolio. And this portfolio did one powerful thing. It removed confusion. That's exactly what we are going to talk about today. This video is not about hype. It's not about getting rich overnight. And it's definitely not about trading. It's about a clear system, a safe starting point, and a realistic path beginners actually stick with. If you stay with me till the end, you'll know why beginners fail with stocks, why ETFs change everything, and how just 3 ETFs can cover almost the entire market. No finance degree needed, no complicated terms, just simple logic. Let me explain this in the most practical way. Imagine investing like building a house. Stock picking is like choosing one brick and hoping it becomes the strongest brick ever made. ETFs are like buying the entire building. If one brick cracks, the building still stands. That's why this works for beginners. And no, this is not theory. Millions of everyday people in the US, teachers, engineers, nurses, office workers, have used this exact approach for decades. Slowly, calmly, consistently. And many of them became wealthy without ever picking a single stock. Next, I will show you why stock picking feels smart, but works against beginners, and why simplicity is actually your biggest advantage. Before we move on, quick question for you. Are you investing already, or still stuck deciding where to start? Drop a comment. I read them all. Let me make this very simple. If you don't want to pick stocks, if you don't want stress, if you don't want to check charts every day, you only need 3 jobs done inside your portfolio: growth, stability, income. That's it. A smart ETF portfolio is not about doing everything. It's about covering these 3 roles clearly. First, ETF, the growth engine. You need growth. This is the part that actually builds wealth over time. This is where your money compounds. For most beginners in the US, this role is played by a total market or S&P 500 ETF. Why? Because instead of betting on one company, you are buying hundreds of the strongest US companies at once. Big companies. Profitable companies. Companies that grow with the US economy. You don't need to predict winners. You just stay invested. This ETF does the heavy lifting quietly, year after year. No excitement, no drama, just long-term growth. Second ETF, the stability layer. Now here is where beginners usually mess up. They go all in on growth, then panic when the market drops. That's why the second ETF matters. This ETF's job is stability. It does not need to grow fast. It needs to protect you from yourself. This is usually a dividend or lower volatility ETF. It moves slower, it falls less during crashes, and it gives you peace of mind. When markets go down, this ETF helps you stay invested instead of panic selling. And staying invented is what actually makes people wealthy. Third ETF, the income builder. Now, the third ETF is optional, but powerful. This one creates income, not for spending, not for lifestyle, but for psychology. When you see money coming in, even small amounts, you feel rewarded for staying patient. This ETF pays regular dividends. Those dividends get reinvested automatically. That means more shares, which means more income later, which means faster compounding. You are not chasing yield, you are building consistency. Why this 3 ETF setup works. Here is why this portfolio quietly works for beginners. You are diversified. You are not stock picking. You are not guessing. You are protected emotionally. You are set up for long-term growth. Each ETF has one clear job. No overlap, no confusion. You don't need to change it every year. You don't need news. You don't need predictions. You just need time and consistency. The beginner advantage. Most people fail because they try to be smart. Beginners win when they stay simple. This portfolio removes decision fatigue, removes stress, removes fear, and that's why it works. In the next step, I will show you how much to allocate to each ETF and how beginners should balance growth versus safety without overthinking. This is where most people finally feel confident enough to start. Now that you understand the three roles, the next big question is obvious. How much money goes into each ETF? This is where beginners usually get stuck. They overthink percentages. They search for the perfect allocation. Let me save you years of confusion. There is no perfect allocation, but there is a safe, smart starting point. The golden rule for beginners. Your allocation should match two things: your age, your ability to stay calm when markets drop. That's it. Not IQ, not experience, not income. The simple beginner allocation. For most beginners between 22 to 40 years old, this is a clean, stress-free setup. 60% growth ETF, 25% stability ETF, 15% income ETF. Why this works? The growth ETF pushes long-term wealth. The stability ETF smooths volatility. The income ETF keeps you emotionally invested.
Nothing is extreme, nothing is aggressive, nothing is slow. It's balanced. If you are closer to your early 20s, and you are okay with market ups and downs, 70% growth, 20% stability, 10% income. This gives you more compounding power without going all in on risk. If market drops stress you out, or this is your first real investment, 50% growth, 30% stability, 20% income, you will sleep better. And sleeping better means staying invested longer. Longer time in the market beats higher risk every time. Let me be very clear here. Do not chase high dividend ETFs. Go 100% into growth. Change allocation every year. Panic rebalance during crashes. This portfolio works because it's boring. Boring is good. Boring builds wealth. How often to rebalance? This is important and simple. Once a year. That's it. Pick 1 month. Same month every year. You are not reacting to news. You are not timing markets. You are just resetting percentages calmly. This alone puts you ahead of most investors. Why this step matters most? This step turns ideas into action. Without allocation, a portfolio is just theory. With allocation, you finally have a clear plan. No guessing, no fear. In the next step, I will show you how beginners actually invest monthly, how much to start with, and how this portfolio grows quietly over time without effort. This is where investing finally feels simple.
So far, we have chosen 3 ETFs and allocated percentages. Now it's time to actually invest without overthinking or stress. This is where beginners feel nervous, but I will make it simple. Step 1. Open a brokerage account. You need a simple, reliable online brokerage. Popular beginner-friendly options in the US include Vanguard, Fidelity, Charles Schwab. Why it matters: low fees, easy ETF purchases, automatic investing features. Make sure your account supports recurring investments. This is crucial. Step 2. Decide how much to start with. You don't need a fortune to begin. Even $100 or $200 per month works. Here is why beginners should not wait. Compounding grows over time. Small, consistent amounts beat occasional big investments. You train the habit of investing without stress. Step 3. Set up automatic recurring investments. This is the autopilot part. Most brokerages allow you to schedule monthly transfers from your bank, automatically buy ETFs according to your allocation. Example, $600 monthly investment, $360 growth ETF, 60%, $150. Stability ETF, 25%, $90. Income ETF, 15%. Once this is set up, you never have to think about it again. Your portfolio grows quietly while you live your life, literally investing while you sleep. Step 4. Avoid overreacting to market movements. Beginners often fail here. Markets will go up and down. You will see numbers fluctuate. Emotions try to trick you into selling. Remember, the portfolio is designed to handle volatility. Don't touch it unless your allocation is off by more than 10%. Step 5. Let time do the work. Here is the magic. Growth ETF compounds over decades. Stability ETF keeps you calm during crashes. Income ETF adds reinvested dividends. You are not timing the market. You are consistently building wealth, step by step. Even beginners who invest a small amount every month see long-term results. Step 6. Why this autopilot approach works. No decision fatigue. Everything automated. Emotion-proof. You don't panic during crashes. Consistent compounding. Small amounts grow big. Beginner-friendly, simple, safe, and predictable. Next, we will cover common beginner mistakes to avoid so you can protect your portfolio, stay consistent, and maximize results.
Now that you know how to set up your 3 ETF portfolio on autopilot, let's make sure you don't fall into common traps that most beginners do. Mistake number 1. Beginners often see a stock going to the moon and panic buy. This is exactly what we avoided by using ETFs. Your portfolio is boring by design, and boring builds wealth faster than chasing hype. Second mistake. Some beginners rebalance weekly or monthly, chasing market news. That's a mistake. The rule is, check allocation once a year, not daily. Consistency beats short-term reactions every time. Third mistake. Income ETFs may pay dividends. Don't withdraw them. Reinvest automatically, it compounds faster. Even small dividends add up over decades. Fourth mistake. Beginners often delay thinking, I will start next month. Every month you wait, you miss compounding. Start small. Start now. Time is your biggest advantage. Remember, beginners like you have become wealthy using the exact same system. No stock picking. No stress. Just consistency, simplicity, autopilot setup. Millions of everyday people in the U.S. have followed this path. Teachers, engineers, nurses, office workers, and many have quietly built serious wealth. If you found this guide useful, comment below which ETF you are starting with. Like the video if you want more practical, beginner-friendly strategies. Subscribe to follow this channel for more real-life investing guidance. Curious how ETFs compare with individual stocks? Check out my next video. It will help you decide your next step safely.